Welcome to Making Money. This is Matt McCall. Thanks for joining me. It's Thursday, August 10th, 2023. I have a great guest coming up for you today. We're going to talk U.S. markets, but also opportunities overseas. Don't shut it off right now because you know many people hear about opportunities overseas. It freaks them out. They only want to invest in the U.S. But Meb Faber is coming on. He's the CIO of Cambria Funds. He's been on in the past. He's been at Stansberry conferences. You've seen him on TV. The guy does the rounds. He's been in his business for a long time. We've been friends for over a decade. I highly respect him, and he's a great guest. But we're going to break down where the markets are now, why he thinks the U.S. is expensive compared to overseas, and where the opportunities are right now. Asia, Eastern Europe, South America, you name it, he's naming names. All that and more coming up right now on Making Money. Over 1 million people around the world follow Wall Street veteran Mark Chaikin for his shockingly accurate stock market predictions. He just gave them a dire warning. Mark says we're about to witness an historic stock market shakeup that can soon create devastating losses for investors who don't know what's coming. And as a result, you only have 90 days to move your money. You see, Mark spent 50 years on Wall Street at some of the most prestigious hedge funds in history. And he's been on Fox Business and CNBC countless times. But this is a financial story no one else is telling. And if you let this take you by surprise, you could be in for a world of pain. He explains everything in a brand new free report available at rollingcrash2023.com. He includes a name and ticker of a popular stock that could be directly impacted by what's happening as well. Mark warned of the beloved pet brand Chewy before it fell 45%. Tech company C Limited before it fell 66%. Furniture company Wayfair before it fell 76%. Social media favorite Snap before it fell 36%. And food delivery company DoorDash before it fell 65%. Mark even called the Amazon crash before the FANG stock fell 35%. So you'll want to avoid the stock in this new report immediately. Again, simply go to rollingcrash2023.com for your free copy of this new report. All right, folks, here he is again, repeat guest, and one of my favorites for a long time. I think I said this last show. I think I met Meb for the first time 12 years ago, let's say, at an ETF conference, I believe in Florida somewhere, put on by Matt Hogan and a couple of the other guys. I don't remember, but I remember seeing you on stage back then. We're still young guys, but we were younger then, Meb. So we were especially young in the industry back then. So great to have you back on, and always love getting your insight, and look forward to see what you think about this market here.
Yeah, it's great to be here. I was laughing because this morning I had someone respond to an email from 11 years ago. I said, "This is really the long game. You've kept this sucker archived for 11 years. That's amazing."
I can't find emails from 11 days ago, let alone 11 years ago. Heck. So tell me, Meb, what's your view in the market here now? I know you're more of a big picture guy like me. We've had one hell of a run here year to date in the U.S. equities. We'll talk international equities in a moment, but what's your view right now in U.S. equities, kind of being led by these large tech companies that we've seen?
Look, man, it's summertime. Everybody's at the beach here in LA. No one's paying attention to markets. Markets up, everything is good again. This cycle really post-financial crisis, so GFC back in 2009, has really been an amazing run. Stocks have done double-digit returns over this period, which is always great if you're a U.S. stock investor. But really, particularly if you look back, through the lens of history, everyone owns U.S. stocks. They're all in on U.S. stocks. We do our Twitter polls. We love to ask polls on Twitter to kind of gauge the sentiment of what's going on. And we say, do you own stocks? And it's 95% yes. And if you do own stocks, it's always for the Americans, all in on U.S. But it's interesting because there's become somewhat of a cult of own stocks at any price. And so the second part of that question was, would you continue to own stocks if they hit a 10-year Shiller CAPE ratio, so PE ratio of 50, which is higher than it's ever been in the United States. It hit about 44 and change in the peak internet bubble in 99. It's been as low as 5. On average, it's around 17, 18. And when inflation is mellow, it's usually around 22. For perspective, we're about 31 today. And 2/3 of people, or 3/4, I think it was 3/4, said yes, we'd continue to own stocks. So higher than any bubble valuation we've ever seen in history in the US, 150 years. I said, would you continue to hold them if they hit a P ratio of 100, which is higher than any country in the database of the past 100 plus years? And this is higher than Japan in the 80s, which preceded their stock market going nowhere for decades. And half the people said yes. So there's this cult of own stocks at any price, which is, by the way, not what John Bogle really promoted. If you can go back, we have a video of him talking about adjusting your asset allocation based on what's been going on. And what's been going on has been this US stock market boom. And if you look back in history, there's been, we did a chart on Twitter where if you look at the rolling 10-year returns, and another way to say this is you could look at, people say, no, but you got to look at risk-adjusted returns. So say the Sharpe ratio, meaning stock returns minus risk-free rate divided by volatility. Usually it's around 0.2, 0.3. And anything, a Sharpe ratio above 1 is like, Hall of Fame hedge fund material. And there's been 4 times in history where that rolling 10-year Sharpe ratio has been above 1. It's been the roaring 20s from 100 years ago. It was the Nifty 50 market in the mid-century, the internet bubble, and then this recent COVID meme stock, whatever you want to call it, 4 times. Now, the other 3 times, on the backside of those was terrible market returns. And so this is much more of a technical way of saying the good times usually follow the bad, right? In the markets, yep. That's kind of an RN law. So it's been a great run. Pat yourself on the back, U.S. stock investors, but also, I think that usually splash a little water in your face gives you some pause for caution.
So all that being said, your ETFs that have exposure to U.S. equities, is there a change in strategy then to kind of combat potentially lower than average returns in the future?
Good note, because it's always important to ask people sort of what their incentives are, right? And my largest fund is actually a U.S. stock fund. So people are always like, Meb, what are you doing? What are you talking about? You're a U.S. stock fund manager. It's your biggest fund. It's almost $1 billion. And let me be very clear. When I talk about U.S. stocks in general, I'm talking about market cap weighted. If you go out and buy the S&P, if you buy a Vanguard market cap weighted fund, most people don't know, but market cap weighting, this passive exposure, is simply the price of the stock. There's no other variable. It's price of stock times shares outstanding. So you own a lot more of a stock, the more it goes up, Apple, Amazon, whatever, and you own far less as it goes down. And it's a great way to index because it lets you do it at low cost. The problem is there's no tether to fundamentals. And so in boom periods, particularly in bubble periods, that no tether causes you to have an allocation that's really not probably what you want. So right now is a great example. We think it's one of the best times ever for value in decades. If you look at the value spread, so market cap weight versus, we call it shareholder yield. Our fund is a shareholder yield focus, which means looking at dividends and net buybacks coupled with low valuations. These value spreads are some of the highest they've ever been in the United States. Value for much of the past 10, 15 years has done poorly. It's done better over the last 2 to 3 years. 2020 was the worst year ever for value, followed by a great year in 2021 and 2022. 2023, you're having a bit of a bounce and sort of the stuff that's been heard over the last few years. So value, we think, is a huge opportunity. You're looking at PE ratios in the mid-single digits, which is pretty astonishing to me compared to certainly double or triple that for the broad market. So we said if you're ever going to do value, probably now is the time.
Yeah, it makes great sense. I mean, value has really been out of favor for so long now. I don't say I'm against value. Sometimes people kind of bust my chops because they're like, how can you call something value when you're a growth investor for the most part, innovation? So if I'm investing in innovation, obviously there's going to be a lot of growth potential there. Yeah. But stocks can still get cheap, right? Growth stocks can still get cheap.
There was a really great piece put out that you'll like by my buddy Kai Wu, where he was talking about looking at growth stocks, but still using a value prism. I mean, look at Warren Buffett, right? So in our shareholder yield ETF, we owned Apple from 2013 till like 2020. Most people call that a growth stock. It's also a mega cap. It's a multi-trillion-dollar company. So just because a company is growing doesn't mean it can't also be value. And when I think of value, Buffett would say it's two sides of the same coin. You can have a stock that's growing earnings at 25, 50% and it still be a value stock if the growth is there.
Yeah.
One of the things that the Kai wrote about in this when he was looking at, a lot of stocks, particularly ones with the super high multiples, is that when you focus in an area like growth, when you start paying a lot, 40 times sales, 100 times sales, some of these companies, it can get challenging because people love talking about value traps. Well, there's also growth traps where they disappoint. Mm-hmm. So I think having both ideas in your head is very much, to me, a required part of being an investor, to where you still got to think about the price you're going to pay for something as well as the growth it's going to have.
Yeah, that's a great way of putting it. Did you ask people, you talking about the Twitter polls that you do? And, obviously most people in the U.S. are heavily invested in U.S. equities. You ever ask how many people in the U.S. are invested overseas, or what percentage? Yeah. Or do you guys have studies of that?
I mean, come on, it's we know the answer. It's nothing. The average for U.S. investors, they put 80+% in the U.S. I think now it's closer to 90. Emerging markets are like, you may as well not even ask. It's the average allocation in the U.S. is right around 3%. And so for prospective listeners, the market cap for the U.S. Is 10 times bigger than any other stock market in the world, but you're putting in 60% in the U.S. if you just index to the world. So already the people who are putting in 80 or 90% are way overweight the U.S. U.S. as a percentage of world GDP, people always get this wrong, is only about a quarter. Population is, single digit, right? So it's a area where even if you're, in my opinion, hugely bullish on the U.S., you love the U.S., 60% to me seems like plenty, 10 times more than any other stock market, right? So there's very much this home country bias. It happens everywhere in the world, though, of course. It's even worse in smaller countries like Canada or South Africa, Australia, Japan, where they're a much smaller percentage of the world, and then people put everything in on their own country. And you ask most people around the world if that was a good idea over the past 3 decades, and they would tell you assuredly it absolutely wasn't.
Yeah, I mean, I remember, emerging markets for years when the BRICS were hot, obviously crushed the U.S. stocks for many, many years. And they've been lagging, and we could talk about valuations in a second. You're more of an expert on that. But you look at the valuations of some of these emerging markets, the amount of research I do over the weekends, and I feel like India keeps popping up. The amount of money that India is going to be spending on infrastructure in the next 10 to 15 years is, I read the number this weekend, is in the trillions. It was a number I couldn't even fathom how much they're going to put into roads and the concrete that they're going to need. And I started thinking back, there was a company I followed years ago, Meb, in China, is Anhui Cement. It was like one of the 1,000 baggers back in the day. It went up literally 1,000x. And you think, wow, if India is now in that growth stage where China is with infrastructure, they now have more people than China. How is there not amazing opportunity over there? And how do we gain exposure to that? Do your funds have exposure to some of that stuff?
Sure. Yeah. So we have a foreign and emerging shareholder yield fund as well. We also have a global deep value fund. And, the big consideration is, you hit the nail on the head when you talk about the sentiment. From 2000 to 2007, emerging markets absolutely creamed U.S. stocks, right? Mm-hmm. And that feels like not too long ago. It's starting to feel like a long time ago at this point. Yeah. But and then this cycle, the U.S. has beaten everything else. There's a great stat I love, which is this is a Bridgewater piece. We summarized a few of these in a blog post we did called "The Case for Global Investing," and they have where they look at a diversified portfolio, so it's equal weight or GDP weight of the world. And then they look at all the other countries. And so they say U.S. outperformed everything in the 2010s, right? And then you flip that the prior decade, and the U.S. outperformed everything in the 1990s. But then you would have to go back, even though the U.S. beat most everything for the 20th century, you would have to go back to 1910s for the U.S. stock market to outperform the equal weight or the global GDP weight. So on average, diversifying globally makes a lot more sense, particularly during the bad times. The big fat drawdown is when you really want to be diversified. But going back to 2007, all everyone wanted was emerging markets, BRICS, China and India. At that point, the 10-year P ratios were in around 40, 50, 60. So bubble territory, and they had horrible returns for the 10 years after that. But fast forward till now, and nobody wants them. It's a classic market sentiment where you look at countries like UK. You look at, there's a long list. Most country stock markets are reasonably priced to cheap to very, very cheap. And the outlier tends to be kind of US on the market cap side. On the actual, if you get rid of these just giant companies, it's actually okay. But nothing changes sentiment like price, and if the price starts going up in places, you could see that shift very similar to how it shifted the decade prior to this last one.
Yeah, I'm just looking at the 10-year return of the SPYs with dividends, about 220%. Then I pulled up VWO, the Emerging Market Vanguard ETF, with total return basically flat, up 7%. That's insane. That's over a 10-year time frame, the outperformance. And I'm going to make this very simplistic. At some point, that shifts back, doesn't it? Where you kind of the regression to the mean, that's just too far apart to me that I see such great opportunity in emerging markets. I feel like China is going to stimulate the hell of their economy next couple of years. They don't want to be where they're at. They want to stimulate. So, why not? We've been stimulating the shit out of our economy forever. It's amazing how much money being put into it. So, I think there's such great opportunities overseas. Is there any area you're looking at or any region in your funds that you see really good opportunity now?
Yeah, so we have a research service. It's free. It's called the Idea Farm. We send out a once a week email on Sundays with some of the curated top investment podcasts, institutional papers, quotes. We do a quarterly valuation update where we send a ranking of the 45 stock markets around the world from cheapest to most expensive. And it's fun. You go to ideafarm.com and you can sign up. And one of the parts of that is that you get this perspective, and we track not just 10-year P ratios, but 10-year price to book, price to cash flow, various measures. And we kind of average them out. And let's see, can you guess? This is too hard on air to put you on the spot. Let's see if you can guess any of the 5 cheapest countries around the world. Usually, the secret to this, listeners, by the way, is the very complicated. Usually, it's the P in the PE ratio. So the way something gets to a PE ratio of 5 is usually because it's down 80%, right? It's not some really complicated thing. And usually when markets are at all-time high, they tend to be more expensive. So
let me give it a shot because I do read Idea Farm. So I might have a couple, and I remember the valuation came out just recently, if I'm not mistaken.
Yeah.
I don't know if Russia's counting because what's going on. If it is that in there?
Russia, we have the painting, the scream. So we have an emoji for Russia because
I thought so. I'm trying to think because I didn't think it was on
Russia
Argentina?
would be, but they're currently on pause. It's like the game is on pause for Russia right now.
How about Argentina?
Oh, well, so all right. You're getting the two that basically are on. Argentina is always on the border of frontier / emerging, so we actually don't calculate Argentina. I'm guessing it would be in there, certainly, but so these are two passes. Neither of those count because they're not in the database.
I would think maybe something in South America, maybe Brazil might be in there.
there's so you got. For the continent, there's now, and these names change over time. For a long time, this was Eastern Europe. We got Colombia as our cheapest country. Poland is number 2. Chile. So you got 2 South America. Czech Republic, which is another Eastern Europe, and then Brazil. So of the top 5, it's literally Latin America and Eastern Europe. So, but the problem with investing in the pure cheapest countries, A, is some of these are small, and B, listening to this podcast and pulling up your E-Trade or Robinhood and going to buy Colombia and Poland, I think for
Yeah.
most people is going to feel very, very risky, very foreign, very uncomfortable. So that's why we think buying a basket, certainly, or diversifying across a dozen countries makes a lot more sense.
I've been looking at some of these emerging markets, Meb, and I just want to take most of my stuff out of the U.S. and go into India and find some opportunity in China, Vietnam. I like Chile. I mean, there's certain areas I want to start pouring money into, and it's tough not to. But it's hard. It's hard doing it when nobody else I'm talking to is doing it. I'm the first guy at the bar. It's tough to be that guy.
I think the way we describe it, and this is extremely technical, is you close your eyes and hold your nose, right? You buy something, you put it away to the extent you can. If you had a lockbox and put it away for 3, 5, 10 years, and I think that's hard for most investors to really, actually do in practice. They want to look at their trades daily, weekly, quarterly, but a lot of these, we have a chart that we put up on Twitter that we said, what if you only had to make one decision in your career? And that drove all our decisions. Bill Gross actually wrote about this once when he was talking about, was he lucky or good with being around during just this declining interest rate environment that his entire career essentially was a part of. And one of the things I talked about is I had 4 dots. There was 2 dots in the end of the 1980s. And this was a valuation of U.S. versus foreign stocks. So U.S. was really cheap and foreign stocks were really expensive, largely due to Japan. And then I looked at today, and the dots are like on the exact same level, but the colors are flipped, right? And kind of was saying something similar. And where, there's this big opportunity ex-U.S. Versus, just investing all your money in the U.S. Now we've done a lot of posts on investing ex-US in the past year or two, and they're consistently our least popular posts. So that might be another sentiment indicator for you too.
It's funny you say that because we recommend at least 2 stocks a month add to our 2 portfolios in the newsletter, and I'm always stoked when we get something that's an ADR trades here. It still may be a very large company in Europe or in Asia. But I'm like, man, people should love this. It's a company probably never heard of. It's a great story. There's a great reason to buy it. And again, people are like, I don't want that. It's for some odd reason, because it's based in Germany. Well, the largest economy in Europe, it's still too risky for them. What's risky is, like you said, 90% of their money's in U.S. stocks. That's the risky aspect.
Yeah. The problem too, I think, is that people get hung up on, it's 2023 and borders and geography are becoming increasingly meaningless, where you have companies that are in the US that have very little revenue exposure to the US. You have companies that are domiciled in UK where 100% of the revenue is elsewhere. And so is that a British company, or is the company that's located here and has no U.S. revenue, is that a U.S. company just because its headquarters is here, or their headquarters not? It's a very interlaced world at this point where the borders are increasingly meaningless. And so, in that concept, is why would you limit your search to just one area? That makes no sense to me. But
never made sense to me, but a lot of shit doesn't make sense to me. So I'm in my own camp over there. Yeah. Before they go, let me think, what about the big picture stuff? Are you worried about what the Fed may do in the next meeting or next 2 meetings if they're going to raise again? Are you worried about inflation being sticky? Are you worried about the election coming up next year? Any of that stuff come into it, or do you kind of let the numbers speak for you?
All 3, actually. So, my big takeaway for most investors, is you need to have a global portfolio. You need to have global stocks, global bonds, global real assets. Those are the kind of 2 big mistakes most investors have. They have no real assets. They may have a house, but other than that, they have no real assets. They don't have global investments. And I'm speaking mostly to my US friends here, but it applies to most people elsewhere in the world. Just insert your own country. And then, I think being mindful of expenses and fees. And the last one for me is adding trend following, which is something that most people don't do. But once you have a portfolio, you should spend very little time, in my mind, worrying about it. Right. Mm-hmm. Now, you could trade it, you can invest, and have an approach, but The worry part, I think, should be front loaded, and you worry about how to construct it and how to think about it ahead of time. So once it's set up, you can kind of let it roll. The second part, though, when you talk about inflation, inflation tends to be the investor's biggest enemy. And the big problem, as inflation has come back down, I think it'll go back up into year end. Not crazy, but I think it will be stickier. But the problem with inflation is that when inflation is elevated, and it doesn't have to be 5, 6, 7, 8%, it could just be 4, is investors are really unwilling to pay as much as they usually do for stocks. The multiples are not as high on average, historically speaking. And so, that is something hopefully that doesn't happen, because inflation is a huge drain for everyone. But over time, it's one of the big risk really for any investor anywhere is the eroding part of inflation. I mean, look what happened to bonds. My goodness gracious.
Yeah.
Going from 0 to 5 pretty quickly has been a pretty historic event on bonds. And so you're near, we back to our Twitter polls, we love to ask people, we say, what's the historical largest real drawdown on bonds, like 10-year bonds, past 100 years? And everyone's like 0 to 5% or 5 to 10%. And I was like, no, it's over half. Like, you lost half your money at one point. And when you look at this recent one, we were talking about before the show got started, zeros and 30s and all the fun stuff. They're really volatile. They make meme stocks look relatively mellow by comparison.
Well, I won't tell people we talked about what I did in my trade. I'm not putting that out there. It's way too risky. But I'm pretty sure I asked you this last show. I ask every guest before we let them go the island question. 10 years on an island, probably some good surf where you want me to send you and your family and your friends. Of course, you could pick one of your own funds. But what's the one investment that you feel really good based on where we are today and where we're going to be in 10 years from now?
Well, as usual, I don't follow the instructions. I'm going to have to answer this with two ideas. If in my mind you're looking to maximize sort of compounding, I love this sort of foreign ex-US shareholder yield concept. The metrics just look fantastic to me. But as we know, a long-only equity exposure can be pretty painful for a lot of people. So if I have to it's an allocation where I'm just can kind of just chill and not worry about it. I definitely love a global trend following approach. So we have a momentum and trend fund that kind of really goes where the tide's taking you, and will invest in the top third of world assets by momentum, but only if they're above their long-term trend. And right now that's been mostly equities, a few sectors like tech, and global as well. And then also a smattering of precious metals. Though I wonder if the precious metals are going to be coming out soon here at the end of the summer, because they gold's kind of gotten around that 2000 level and kind of chilled out a bit. Been waiting for gold to break out, but haven't seen it happen yet. So for maximum compounding, to me, it's the ex-US shareholder yield. For if I want to live my life and not worry about it, it's global trend.
So is that FYLD and GMOM?
Yeah, I mean the symbols we run is FYLD, EYLD is the emerging market one, and our global momentum ETF is GMOM. GMOM.
Okay, excellent. Yeah, that's nice because you get a little bit of the not safer, but safer plays, and you have the momentum too that can take advantage of that momentum that's moving along. But
that's the hope.
Hey man, thank you so much. I'm going to see you in a couple of weeks at Future Proof out in LA, right? That's going to be
at Future Proof is in Huntington Beach, so not quite LA, but close enough to call it SoCal.
I'm a non-California guy. To me, right. All that whole area is LA. Between there and San Diego.
Come say hi, listeners. You grab me, I'll buy you a beer. I'll be at the Stansberry conference in Vegas as well. So I guess there it would be a pina colada in the pool in the lazy river. But, we'll be at both.
I better not see you drinking pina colada out there. We need you on. We need you on a podcast where you're speaking on stage. We need you.
This is the beauty of being a quant, is like all the business all the systems run themselves. And I hang out with fun people like you and talk talk shop. But we'll be at both. So or listeners, come say hi to us in Manhattan Beach. We're here as well.
Yeah. Reach out to Meb if you have anything. Make sure you follow him on Twitter. Watch this podcast. Sign up for Idea Farms. I read it every Sunday. I just read it yesterday. So there's always great ideas in there. I curate a lot of information for you, making your research a lot easier. So thanks for doing all that work, Meb. Really appreciate it.
Thanks, bud. Thanks for having me.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.